A tech founder sells his startup for $50 million, walks away with $48 million after taxes. Meanwhile, you sell stock for $50,000, walk away with $38,000. You paid 24% federal capital gains tax. He paid 4%, not because he's rich, not because he cheated, because he used a section of the tax code, Section 1202, the Qualified Small Business Stock Exclusion. And it's completely legal. 100% exclusion on the first $10 million of gains, or 10 times your original investment, whichever is greater. Zero federal tax on $10 million. This isn't offshore banking, isn't tax fraud, isn't even aggressive planning. It's written directly into the Internal Revenue Code, has been since 1993. And almost nobody knows it exists. Not your accountant, not your financial advisor, not even most tax attorneys, because it was designed for small business owners, mom and pop operations, hardware stores, local manufacturers, people starting companies the hard way. But Silicon Valley discovered it and turned it into a wealth creation machine. Every tech founder, every startup entrepreneur, every venture-backed company, they all use Section 1202 legally, systematically, strategically, while you pay full freight on every dollar of capital gains. Because nobody told you, because the system is designed to be opaque, because tax advantages are written in language nobody understands and distributed to those who know where to look. This is the loophole they never thought you'd notice. But you're about to, and it might be the most valuable 20 minutes you've spent this year. The history matters because it shows intent, shows how good policy becomes exploited advantage. In 1993, Congress passed the Revenue Reconciliation Act. Bill Clinton signed it. The economy was recovering from recession. Small businesses were struggling. Venture capital was limited. Congress wanted to incentivize investment in startups, in small companies, in the engine of American innovation. So they created Section 1202. If you invest in a qualified small business, hold the stock for 5 years. You can exclude up to 100% of the gains when you sell. The original exclusion was 50%, later increased to 75%, then in 2010, made 100% retroactive for stock acquired after September 27th, 2010. The limits were generous. $10 million per investor, or 10 times your investment basis. For a company founder, this meant you could create a company with almost nothing, build it for 5 years, sell for $100 million, and the first $10 million completely tax-free at 23.8% capital gains rate. That's $2.38 million in taxes saved per founder. If you have 3 co-founders, $7 million saved collectively. And the intent was pure. Congress wanted to reward risk-taking, wanted to incentivize entrepreneurship, wanted Americans to build companies, not just trade stocks, but they made it generous enough that it became a Silicon Valley standard, a wealth creation loophole hidden in plain sight. The qualifications seem restrictive, but they're not. The company must be a C corporation, must have less than $50 million in gross assets when the stock is issued, must use at least 80% of assets in an active trade or business, can't be in certain industries, banking, insurance, farming, hospitality, restaurants, professional services. But technology companies qualify. Software, hardware, biotechnology, e-commerce, SaaS platforms, pretty much everything in Silicon Valley qualifies. And here's the key. The $50 million asset test is measured when the stock is issued, not when you sell. So you can start a company with $1 million in assets, get issued stock as a founder, grow it to $1 billion valuation, and still qualify. Because when you receive the stock, the company was under $50 million. This is where the magic happened, where the loophole reveals itself. A founder starts a company, incorporates as a C corp, gets issued founder's shares for almost nothing, a few $1,000s, maybe $10,000. The company is tiny, 2 people in a garage, $50,000 in assets. 5 years later, the company has grown, has revenue, has burned through venture rounds, is valued at $200 million. The founder sells $10 million in gains, qualifies for exclusion, 0 federal tax. The other 90 million pays normal capital gains. But that first 10 million completely tax-free. And if the founder sold earlier when the company was worth only 20 million, the entire gain might be tax-free. If they invested 10,000 and it's now worth 5 million, that's 500 times return. But only the first 10 million qualifies. Still 5 million in tax-free gains. That's 1.2 million saved. For knowing about Section 1202, if you're starting to understand that there's a part of the tax code that lets founders keep $10 million tax-free while you pay 24% on every dollar, and that this has been law for over 30 years, then you need to see how this actually works in practice. Subscribe now, because what comes next shows you exactly how to qualify, how to structure, how to make sure your stock is QSBs, how to document it, and how to use it even if you're not a tech founder. Because this isn't just for Silicon Valley, it's for anyone starting a business, anyone building something, anyone willing to take the risk and hold for 5 years. The knowledge you're about to gain might be worth millions. Literally, if you act on it, if you understand it, if you structure your next venture correctly. The venture capital world runs on QSBs. It's not advertised, not talked about publicly, but every term sheet, every founder agreement, every investment document mentions that VCS structure deals to preserve QSBS status, make sure the company is a C-corp, make sure founders get stock when assets are under 50 million, make sure the company isn't in an excluded industry. It's a checkbox on every deal. Because VCS know, founders know, lawyers know that 10 million tax-free is worth 20 million. Changes the economics entirely. Founder who can keep 10 million tax-free is effectively getting 13 million in value compared to someone who pays full freight. That's a 30% bonus for structuring correctly. And it's compounding because every founder who raises venture capital ... qualifies. Every startup that exits uses QSBs. It's become the standard, the expectation, the Silicon Valley secret. That isn't really secret, just unknown outside the ecosystem. And that creates a wealth gap. Not between rich and poor, between informed and uninformed. Between those who know the code and those who don't, between those who structure their businesses to use available tax benefits and those who just ... operate and pay whatever the accountant says they owe. Never questioning whether there's another way, a better way, a legal way to pay less. But here's what makes it accessible. You don't have to be a tech founder. Don't need venture capital. Don't need to build a $1 billion company. You can start a small business, a consulting firm that creates software, a manufacturing company, a distribution business. As long as it's a C-corp, has under 50 million in assets. When you get your stock, operates in a qualified industry, and you hold for 5 years, you qualify. The exclusion applies, 10 million tax-free, or 10 times your investment. So if you invest 50,000 to start your company, grow it over 5 years. Sell for 600,000, that 550,000 gain is completely tax-free if you structured correctly. If you knew about 1202 when you started, if you documented it properly, that's 130,000 in federal taxes saved, plus state taxes in many cases, because many states follow the federal treatment. California doesn't taxes it fully, but most states do. So a founder in Texas or Florida selling a business they started for 500,000 gain pays 0 federal tax, 0 state tax, keeps the entire amount, while someone in California pays 13.3% state tax, even if federal is 0. But still, saving 130,000 federal ... is life for a small business owner, for someone who took the risk, put in the years, built something, and structured it correctly. The documentation is critical, and this is where most people fail. Even those who know about QSBS, you must get a Section 1202 certification from the company. At the time of stock issuance, the certification states that the company meets the requirements that gross assets are under 50 million, that 80% of assets will be used in active business, that the industry qualifies. This certification is your proof when you sell, when you file taxes, when the IRS audits. Without it, you have to prove qualification yourself. Much harder, much riskier. So the process is simple. When you form your C-corp, when you issue founder shares, get a 1202 certification from your CORPORATE lawyer, file it with your stock certificates, keep it forever. When you sell, 5 years later, you have proof the company qualified, the stock qualified, the holding period is met, the exclusion applies. Without that certification, you're arguing with the IRS, trying to reconstruct history, trying to prove asset levels from years ago, trying to show you met requirements. It's possible, but painful. So the real secret isn't just knowing about Section 1202. It's documenting it from day one, from formation, so that 5 years later, 10 years later, whenever you exit, you have ironclad proof that you qualify, that the exclusion applies, that you owe zero federal tax on $10 million of gains. The reformers tried to kill it multiple times. The Obama administration proposed eliminating QSBs for high earners, limiting it to families making under $400,000. That would have destroyed the benefit for successful founders, but it failed. Never passed Congress. The Trump tax reform in 2017 changed many things, lowered corporate rates, but left QSBs untouched, fully in place, 100% exclusion maintained, because it has bipartisan support. Both parties like small business incentives, like entrepreneurship benefits, like policies that encourage job creation, even if the primary beneficiaries are Silicon Valley founders, making tens of millions tax-free. The Biden administration also proposed changes limiting QSBS for high earners, capping the exclusion, reducing the benefit. But again, it failed. Didn't make it into legislation. The loophole remains fully intact, fully available as of today. Section 1202, 100% exclusion. $10 million cap for anyone who qualifies, who structures correctly, who documents properly, and who holds for 5 years. This makes it predictable, makes it plannable, makes it something you can build a strategy around. Unlike other tax benefits that change annually, that get eliminated, that have sunset provisions, QSBs has survived for 30 years through 4 presidencies, through multiple tax reforms. Because it's popular, because it's bipartisan, because it's wrapped in the language of supporting small business. Even if the reality is supporting startup founders making millions. Do you see the asymmetry? A working professional saves 4 years, invests in index funds, builds a nest egg of 500,000, sells to retire, pays 24% federal capital gains, 120,000 in taxes, keeps 380,000. Meanwhile, a founder starts a company, builds it for 5 years, sells for 11 million, pays zero on the first 10 million, only pays tax on the last million, total tax 238,000 on 11 million, effective rate 2.2%, while the professional paid 24% on 500,000. The system is designed this way, rewards risk-taking, rewards business creation, punishes passive investing, punishes safety. You might think that's fair, that founders take more risk, deserve more reward. And maybe you're right. But the question is, did you know you could be the founder? That you could start a business, structure it as a C-corp, get QSBS benefits, and pay the founder rate instead of the employee rate? Most people don't know, don't consider it, don't think they can be founders, but the bar is low. Any business can qualify. Any entrepreneur can structure correctly. Any risk taker can access QSBs if they know it exists, if they understand the rules, if they document properly. The unfairness isn't that founders get benefits. It's that employees don't know they could become founders and access the same benefits legally, ethically, strategically. Here's how you actually use this. Tomorrow, next month, when you're ready, first decide if you want to start a business. Any business. Consulting, software, manufacturing, distribution, e-commerce, something that can scale, something that can grow, something worth building for 5 years. Then structure it correctly from day one. Form a C corporation, not an LLC, not an S-corp. A C corp, this is critical. QSBS only applies to C. Make sure gross assets are under 50 million when you issue stock. For most startups, ... This is automatic. You're starting with nothing. Issue yourself founder shares for a small amount, whatever makes sense. $1,000, $10,000, document the stock issuance. Get a Section 1202 certification from the company, signed by an officer, stating the company qualifies, stating assets are under 50 million, stating the business is qualified. File this with your stock certificates, keep it safe, then build. 4 or 5 years, minimum. Don't sell before 5 years. The holding period is mandatory. Use 80% of assets in active business. Don't become an investment company. Don't hold passive real estate. Don't hold stocks and bonds. Actually operate, actually build, actually run a real business. After 5 years, you can sell, and the first 10 million of gains, or 10 times your investment, is completely tax-free. Federal, if you invested 10,000, that means 100,000 is tax-free. If you invested 100,000, that means 1 million is tax-free. If you invested $10, that means 10 million is tax-free. But capped at 10 million total per company, per founder. If this has shown you that there's a legal way to make $10 million completely tax-free that you could have been using for years, that requires only structuring correctly and holding 5 years. Then you need to understand what else exists in the tax code. Subscribe now. Because Section 1202 is just one loophole, one benefit, one piece of the puzzle. The tax code is 17,000 pages, filled with benefits, exclusions, deductions, credits, written for those who know, written for those who ask, written for those who structure strategically. The next investigation reveals the others: the step-up in bases, the installment sale, the opportunity zones, the 1031 exchange, the charitable remainder trust, all legal, all documented, all available to anyone who learns them. Whose is them who builds wealth the way the code allows. Not the way you've been taught, not the way employees do it, but the way founders do it, entrepreneurs do it, informed people do it. The knowledge is power, the application is wealth, and the gap between knowing and not knowing is millions of dollars over a lifetime. The question is, which side will you be on? The moral is simple. The tax code is not designed to be fair. It's designed to incentivize behaviors. Congress wants people to start businesses. So they created QSBs, wants people to invest in real estate. So they created 1031 exchanges, wants powerfully to save for retirement. So they created 401 kiloseconds in IRAs, wants people to invest in low-income areas. So they created opportunity zones. Each incentive creates a tax benefit. Each benefit creates wealth. For those who participate, the system doesn't reward working hard at a job, doesn't reward earning a salary, doesn't reward passive investing in taxable accounts. The system rewards starting businesses, owning real estate, contributing to retirement accounts, investing in qualified vehicles. This isn't conspiracy. It's policy, written clearly, available openly to anyone who learns it. But most people don't learn it, don't seek it, don't even know to ask. They hire an accountant, file their taxes, pay whatever is owed, and assume that's how it works, that everyone pays the same rates, that the system is neutral. It's not. The system has doors, hidden doors, legal doors. For those who know where they are, QSCs is one door. There are hundreds more, and walking through them is the difference between paying 30% of your income in taxes and paying 3%, both legally, both ethically. The only difference is knowledge, is structure, is intention. This is the loophole they never thought you'd notice. But now you know what the question is, ... What will you do? Will you structure your next venture correctly? Will you form a C Corp? Will you get your 1202 certification? Will you hold for 5 years? Will you save 10 million in taxes? Or will you keep doing what you've always done? Working for someone else, earning a salary, paying full rate, and wondering why wealth seems to accumulate ... for everyone else. While you work harder and get taxed more, the choice is yours. The knowledge is now yours, and the opportunity has always been there, waiting for you to notice.